Hi, it's Martin, and I'm here with Neil Cowie from Robson Laidler Wealth for the next episode of our podcast, Business Stuff. Hi Neil, how are you doing?
I'm very well, Martin. Nice to be with you.
Thank you. And we're going to talk today about making the most of your resources. And you're from a wealth team, so that's primarily going to be people's cash, their assets, that kind of thing.
That's right. Yeah.
Where do people start? What do you mean by making the use of your resources?
It's a big question. I think for us, the way we deal with it with clients is the starting point's not so much where they are now, although that's important. It's where they want to be in the future. Now that might be retirement and having a lifestyle in retirement. It might be a specific goal like buying a new car in 3 years' time. It might be sending their kids to university or private school. There can be any number of goals, but that tends to be the starting point. Once we know where you're trying to get to, it's a bit like a map.
Yeah.
And where you are now, we can then create a roadmap, a pathway to help you achieve that objective.
Right, okay then. And without putting words in your mouth, and it sounds like that's the kind of thing you won't get if you just go on to, I don't know, a comparison site and say, what's the return will I get on this? It's not about products, that's not about returns almost. It's about what do you want to do first, isn't it?
Yeah, a lot of the DIY investing sites is purely about how much money have you got, what sort of investment risk do you want to take with it, and they'll spit out a number as to what you can potentially expect, but that can't be guaranteed, and it bears no resemblance to what you need to achieve to match the goals that you've got and the objectives that you've got.
Importantly, when they might just say, do this,
yeah,
and give you a percentage to expect, but they might give you a long-term target and you might need the money in 2 years' time, or so again, it's never going to be a complete plan, is it? It's only ever going to be with this amount of money you could do this, but that ignores everything else, doesn't it?
Yeah, I mean, I guess it's the value of advice and whether you're willing to pay for it, but it encompasses a very deep, broad analysis of where you are now, where you want to be in the future, and most direct to customer offerings don't give that.
Yeah, okay then. So you mentioned, you're planning for something. I suppose the thing that everyone plans for, whether they know it or not, is retirement. And is it fair to say that's the thing that most people want to plan for, or that's on everybody's list? What's the second biggest thing that people aim to plan for?
I think it's probably even more general than that, because we as advisors deal with people that are both working now and also retired now. So it's not just retirement. It's mainly about most people's goal, whether they articulate it or not, is maintaining the lifestyle they've got, and that lifestyle has a cost to it. The daily things that you spend on, the basics, the nice things that you like to have, the occasional one-off large spends, that makes up your lifestyle, and it's our job to understand what that is and to try and help you maintain or achieve that level of wealth required to sustain that lifestyle.
So that's like setting their needs now. Obviously people's needs will change over their life. Someone in their 20s will have a completely different idea of what being in their 80s is like, and probably have no idea what it's like. What's the kind of things that change people's plans along the way then? Obviously kids, marriage.
Yeah, the kind of obvious life events that you could think about. You perhaps start single, you get a job, you've got some surplus income, you then maybe enter a relationship, you've got someone else to think about. You've
got a deficit of income.
Probably, yeah, if you're like my family situation back in the day, but and then potentially kids come along, and then the retirement, losing jobs, changing jobs, getting a higher salary, illness, death, just the things that happen in life can change all of that. Again, that's why it's important. It's not a one-off exercise. The advice that we give to the majority of our clients, it's an ongoing process, because we recognise things change, both in their own circumstances as well as economic issues, tax issues, things like that.
And the only way you can keep up to date with those things is to be in actual conversation with people, isn't it? I've met loads of people where they've said, I did this 12 years ago and I think it's doing all right. So, well, what you did 12 years ago, you might not still be on that journey, might you?
Absolutely. I mean, when it comes to specific products, there's been a vast change in products in terms of flexibility, cost, choices within them. And it's important to keep those up to date, make sure they remain the appropriate thing for what you're trying to achieve.
Yeah, and of course in 12 years you could be married, divorced twice over.
Absolutely, yeah.
Have 4 more kids than you used to have, or the kids could have moved out and you haven't got that cost now. So anything could have changed.
Sure.
What are the biggest things that people overlook when they're planning? When we first ever started working with you guys, one of the things that I'd never really thought about is possible inheritances, for instance. Say, oh yeah, well I need this amount of money. Oh, but I'm an only kid and my parents are millionaires. All right, well that changes what you need to put away then, doesn't it?
Yeah.
Possibly.
It's quite a difficult question. I think it's the simple things. It's kind of working out. It's old fashioned, but budgeting is very important to a financial plan. Knowing how much you've got coming in every week, every month, and how much is going out and spending every week and every month. We've done blogs. Do you think most
people have no idea what they actually spend on a monthly basis then?
Most people have got no idea what they spend on a monthly basis. Some people are very analytical about it. We love people like that because it helps us do our job. Because they can just answer questions quite easily. Some people have just got a general feeling we're well off. We don't really have to worry, and I get that. But I think the majority of people, it would be time well spent. Just even, it doesn't have to be a long-winded exercise, but now and again, just having a quick flick through the bank statement, the credit card statement, whatever, work out, roughly what's going out on a regular basis, what the sort of surplus is, and then that, you can, from there, you can make some choices about, are we spending too much on certain things, the obvious things like a gym membership you never use, or streaming services that you pay for and never watch anything, that you're wasting money, as well as things like, energy prices, very topical at the moment. Can you get a better deal? Perhaps not at the moment, but traditionally you would be able to do that. Things like that. Of
course, the classic thing that seems to hit the press regularly is if you could just not have avocado on toast every day, you could buy a much bigger house and retire like 30 years earlier. But it kind of is that, but also it's not quite that, is it? Yeah. Like that, if you spend 12 quid on the way into work every day that you don't have to, that's 12 quid a day.
I guess a lot of people are, whether consciously or unconsciously, waste money in various ways. The way you might waste money will be different from the way I might waste money.
You waste a lot of money on golf, don't you, for instance?
Well, I would like to think that's a valuable investment into my lifestyle.
But that's a good example.
What do you like to do? This is all about using the resources to do the things you want to do. Yeah. So if golf's a priority, or travel, or your family, or whatever it is, whatever you want to spend your money on, ask yourself the question, well, am I using my resources in a way that is trying to make that objective happen? And if you can,
and it's not just happen now, it's happen now and for as long as you want it to happen. Absolutely. Isn't it? Yeah. So you might say, well, I want to travel for the next 30 years, and eventually I'll have been everywhere and I'll probably get a bit tired of it. And so you don't plan to travel forever. It's you look at what you need when, don't you?
And again, that changes. So travel's a good example, and you're probably most active in a period of your life, and then maybe towards the end of your life you're less active. You maybe less worried about getting on a plane, traveling distances or whatever. So your goals and objectives and how you want to spend your money will change as well.
Yeah, people tend to do most of their bungee jumping, jet skiing, holidays younger rather than older, don't they? For instance,
bungee jumping hasn't come up as a bucket list, but I guess it'll be on some people's lists.
Yeah, I'm sure. What do you think the things are that people often get wrong on their spending, Neil? Is it? So if you ask most people to do a monthly budget, what will you always see missing on there? Where you go, but you must do these. They go, oh yeah, I do. I mean, do people just not put the annual costs in, or what do people get wrong?
Yeah, I mean, there's a kind of graduation of how simple expenses are. The obvious things that we all spend on are, things like your utility bills, your council tax, maybe the petrol in the car every week, or whatever it might be. The basic day-to-day spending that you can look down your bank statement, you maybe have direct debits for, and it's quite easy to quantify. So you ask people what they spend, and they'll come up with the total of their direct debits for the month. Yeah. But then that's usually less than half what they actually spend in terms of things like the coffee on the way to work, or the night out, or visit to the theatre or cinema, or a meal out, or home improvements or whatever, various categories of expenditure.
And people might say, well, I don't have to do them, that's why I didn't tell you, but people like to do these things.
Yeah.
So again, this is the trade-off, isn't it? Well, do you want to do more of that or more of something else?
That's exactly right. So, we do categorise people's expenses when we do our work with people. We do categorise them between basic expenditure, maybe leisure expenditure, and maybe luxury expenditure. And it might be, I'm prepared to give up a little bit on the luxury side to make sure I'm absolutely solid on the basic expenditure. But people will, adjust those categorisation in different ways, I suppose.
Do you find that people have a different approach depending on what their position is? So an employed person with a decent work-based pension is probably going to have a radically different attitude to the sole trader who has to find every sale, find every month's worth of income. Does that change fundamentally what their needs and desires are? Or are we all the same at heart?
I'm not sure it changes your needs and desires. Again, going back to the generalisation that maintaining lifestyle tends to be the kind of thing that most people want to do. I guess the security of income to enable you to fund that is different, and that might create different challenges for, as you say, the self-employed who are reliant on their day-to-day endeavours to create sales or profits in their business to maintain their wages, whereas someone in a salary position knows that unless they cock up massively, they're going to get their wage every month in their bank account. So it's maybe a different view of where the income's coming from, I suppose.
And have you seen, I can't remember now when auto enrolment came in, but it's been in a while now, hasn't it? I mean, it's this generation, isn't it? Auto enrolment is for anyone who doesn't know, it's the automatic entry into a workplace pension, which I don't know what the stats are, but most people are probably okay if you work full-time for a reasonable size employer. I think that's you're probably automatically in a pension scheme. Has that changed a lot of the way that people look now, or in that most people probably have a base level of some pension expectation? I
think the general awareness of saving and the benefits of that have been increased as a result of auto enrolment. I mean, the UK is a little bit behind countries like Australia, who introduced that quite a number of years ago, and there was definitely the evidence in Australia is that more people are more aware and more interested in their finances. They're more willing to actually put some money aside every month, whether it's in a pension or another savings or investment product.
That's interesting.
So that it's increased the awareness, and by taking responsibility for yourself, albeit with the help of some legislation and your employer, it can only be a good thing in my view.
So it's interesting. So it looks like being forced to do a little bit makes people more likely to then do a little bit more voluntarily.
Yeah. I mean, the government's objective was obviously ultimately to take the burden off the state, or to reduce the burden on the state, so more people would take responsibility for their own long-term financial well-being. And if that makes people question how much they're saving and whether there's scope to save a little bit more, then I think, as I say, that can only be a good thing.
Yeah. I can't remember what it is, but I think there's a book called something, The Richest Man in Babylon or something, where he just basically saved 10% of everything every month forever and he'll be all right. But most people don't have that attitude when they're young, building a home, building a family. It's quite hard to put that money aside at that point in your life, isn't it? Yeah. When arguably that's the bit that's got 50 years to grow, so it'd be great if you could. Is there any way around that, or is that just you have to just do without?
There's lots of formulas and sort of guidance that you can find on the web or in books or whatever. I think the principle of saving little and often and is good. The earlier you start to do that, the more money you're going to have at the end of the day. And I think, again, going back to the point about auto-enrolment, the way that works typically is the money comes out of your salary before you get it, and it goes into your pension fund. So in some ways you haven't had it anyway, so you don't kind of miss it, and that makes it a bit easier to deal with. And before you know it, over a few months, a couple of years, there's a little pot emerging, and it's like an acorn that you plant in the ground, and over time it will grow.
Plus it flexes automatically. If you earn twice the wage, twice as much goes in. And
because it's percentage related, then obviously as your earnings go up, the contribution goes up, which is useful as well.
what are the take-up numbers on auto enrolment? Because you can opt out, can't you? Do a lot of people just kind of go, no, I'll never have a pension, and that's the end of it? We're not selling pensions here, but there is still like a stigma, isn't there, around some people just go, I'll never have a pension, doesn't matter what you say.
I think there's some misconceptions. It's been a while since I've been involved in sort of the coalface in terms of setting up an auto enrolment scheme, but certainly when the legislation came in and we were helping some employer clients set up schemes for their own staff, the general kind of evidence was that the take-up was pretty good. What's happened maybe since then is that the minimum contribution rates have increased, and there's been a bit of a drop-off in contributors as the cost maybe gets a bit more expensive. But I don't know the actual stats, but I'll be confident it's certainly well over half those that are offered a pension join it and continue to pay into.
And you get rolled back into the scheme every couple of years anyway, don't you? So you've got to keep opting out repeatedly if you want to stay out, haven't you?
That's right. Your employer has got an obligation to, if you do opt out, to revisit that decision every 3 years, I think it is.
And I mean that seems to be one of the great ways of leveraging any investment you make as well. Because by you putting your percentage in, you're getting the employer's percentage for nothing, aren't you? So by opting out, you're giving away free money, aren't you?
It's a no-brainer, really. If you can afford to make the employee contribution, why wouldn't you? Because as you say, you're getting the benefit of the employer contribution.
So you're doubling your money before you start, aren't you?
Pretty much,
yeah. Okay then. So pensions. Everyone knows about pensions, and everyone, I mean, I knew a lot of people. You go back 20 years, you had things like Equitable Life, the scandals, Marconi, everyone lost their pensions. So you got a pension, let's say, nothing's guaranteed. Is that just an argument that you should diversify and do multiple things, or just keep an eye on your pension? How do people mitigate that kind of argument?
Sure. Again, going back to maybe a point I made earlier, modern pensions or investment products are very flexible. So in the past, you might well have, set up a pension with one provider with a certain type of fund, and then you might have had a little bit more money in the future and set up another pension with another provider to get that diversification, so you're spreading your risk a bit. You probably don't really need to do that anymore. Modern pensions offer you access to a very wide range of investment funds with low charges, and ultimately the amount you get out at the end will be a direct relationship with the amount that you put in every month, and also what the charges are and how much you or what sort of level of risk you take. Those are the things that will determine the pot size at the end of the day when you retire.
We'll come back on to risk, because that seems to be something you've mentioned risk a couple of times already. Where do people start? If I mean, pension might not be the thing for people, depending on what you want. If you're going to buy that car in 3 years' time, pension's probably not a good idea, unless you're about to retire and get your pension lump sum. Yeah. So, what are the type of things that people normally do? Is leave money in the bank? Should we start there?
Yeah. So there's probably a series of steps that you might want to consider. I guess the first thing is to work out, if we're talking about a monthly figure, how much extra do you have? How much of a surplus do you have at the end of the month? Work out what's an affordable, from that amount, what's an affordable amount that you can commit to saving, whatever that is, or to use in some way. Now, it might be saving's a good idea, generally. We tend to recommend trying to build up a reserve in a bank account, bank savings of somewhere between maybe 3 and 6 months of spending. So if you spend, I don't know, £3,000 a month typically, then you might want to have somewhere maybe 10 to 15 grand as a savings account. Once you've got to that level, then you might think of other things. It might be you might want to repay your mortgage, for instance, or if you've got some expensive debt, high interest rates, you might want to pay that down first. You might want to do that before you
clear the credit cards.
That might be a better use of your money if you're paying a high level of interest. But assuming that's not the case, then beyond cash, then you probably want to be investing some of that surplus, saving it on a regular basis. And the main types of products you would look at would probably be an ISA, and that would usually be a stocks and shares ISA that we would recommend. There's some investment risk attached to that, and obviously we would cover that with a client. And or a pension. The ISA tends to be more for the shorter term, because you can access money in an ISA very easily, whereas the pension, as you've rightly pointed out, you've got to be a minimum age before you access your pension. At the moment that's 55, but it's going up shortly to 57 and 58 beyond that. So.
What one thing I always get is people always think accountants, everyone we know has got loads of money, as well as we've all got loads of money apparently as well. Apparently. And the amount of times I've sat at this table and people went, well, you must know loads of people sitting on loads of cash. But sitting on cash, unless you're someone who's just like striking deals all over the place as like a venture capitalist or something, sitting on cash isn't normally a good idea for most normal people, is it?
No, and when we talk about cash, we mean money in the bank. That's,
yes.
We use the term cash quite freely, but it means it's not literally cash under the mattress.
I don't mean like Pablo Escobar sleeping on a bed of 50s, but yeah.
No, it's money in the bank. And everybody that's got surplus needs that amount or an amount, and I've given some guidance on what we think is an appropriate amount. Beyond that, though, the problem with cash or money in the bank is that it loses value over time because of inflation. At the moment, we've seen the headlines that inflation's running 7%, I think was the latest figure, very high. If you think about, if you're lucky, you'll be getting 1% bank interest, so effectively you're losing 6% a year on those numbers. And money put aside is effectively just deferred spending. And if you can get that money to grow at a better rate, then you've effectively got more to spend sometime down the line.
Yeah. Because we've talked about risk a couple of times, but not really explored risk. So people's attitude to risk, again, so my dad was old school. It's like, it's under the bed, literally. I know where it is.
Sure.
Or he used to call Barclays Billy. I don't know why, Billy Bartley. Billy's got me money and I'm happy with that.
Yeah.
But people assume then that they are zero risk options, but they're not, are they? If the money in the bank is actually losing you spending power year on year, people are already at a position of risk there, aren't they?
Very much so. I mean, there's various types of risk, and you can think of the risk of, I don't know, falling off a high building, or the risk of getting run over in the street by a car. Different types of risks. When we talk about risk, we tend to think about it in three different ways when it comes to investing your money. The first is your general attitude towards financial risk, about losing money. And most people, all people, are on a range, a spectrum, if you like, to use that expression, from cautious to adventurous. And that's your personality, and that doesn't tend to change irrespective of your financial circumstances. You're either cautious, adventurous, or somewhere in between. So that's a starting point. The other way we look at risk is the risk that you need to take. So, or what sort of return do you need to get? And in order to get a higher return, you need to take a higher investment risk. So if your number, the number of your wealth that you need at 60 when you retire, for instance, to maintain your lifestyle is X, then for you to get where you are now to X, assuming other things, you need a certain return, and we can kind of work that out.
Because to put that the other way, if someone comes in and says to you, well, I need 20 grand a year, and I've got £30 million to invest. Yeah. You go, well, that's easy. You can you can be super low risk because you're going to get that all day long.
You could afford to lose money every year and still have enough to.
You could just dip into your capital for years and be fine.
Absolutely.
Whereas if someone says, well, I've got 100 grand and I need that to be 300 in 10 years, they're only going to get there. Correct. They're either going to get there or they're going to lose their money. But they can't do something low risk and then wonder why they didn't get the 300.
No, so, and again, it's not an exact science, and compromises sometimes have to come in. So we tend to layer it up. So one, we make sure you've got enough income to cover your lifestyle. That's the starting point. We've determined that with the budgeting we talked about. Secondly, you've got enough cash for emergency. So if an unexpected cost comes up, the roof blows off, the car breaks down, your kids need jobs, or whatever. Illness, number of scenarios you could think of. You've got an emergency fund that will cover some short-term money. The purpose of investing is typically for the medium to longer term, so sometime down the line.
And what are you classing as medium there then?
3-4 years plus, typically, I would say.
Right.
As long as you've got that emergency reserve, you can afford to take that little bit longer term view, and then things like pensions for depends how old you are, but for most people tend to be very long term. If you've just started work, then that's 30, 35, 40 years perhaps in front of you, which is a long time.
Okay then. So let's say someone's sitting there and think, well, we know what we're spending now, we know what we need, we know what our lifestyle looks like, we've thought about kids, marriage, house moves, car purchases, bucket list trips, etc. We've planned all that out. What happens if something unexpected comes along, then you need a plan B here? So you fall off that building.
Yeah.
And you thought you had 20 more years of working with £1,000 a month spare. You haven't.
It's a tricky one. I mean, you obviously you don't know these events are going to happen. I mean, if you're trying to avoid the financial consequences of these sort of events, so things like what we call protection, so life cover, a premature death of maybe the main breadwinner in a family, that would have a devastating consequence on the family left behind. Simple life cover is a very easy way to mitigate the financial risk of that. You're not going to obviously replace the person, or the emotional impact of that's clearly very high. But
you can keep the house.
But you can pay the mortgage off, have a pot of money to help maintain the lifestyle. That's fairly affordable, easy to set up.
That's one of those things as well, where again, the younger you do it, the better rates you get, because you're less likely to do something
the risk
ends your life.
As a 20-year-old dying before your 60s, relatively low compared with a 55-year-old.
So another good example of don't leave it too long.
Yeah, and then again, it's about prioritising the surplus that you've got and the goals you're trying to achieve, and we would typically encourage people to think about protection before they start investing money, but some people have already taken care of that and therefore have got the surplus that they can commit to investing. But so the what would happen if kind of scenario, life cover is an issue, you might think about something called income protection, which is designed to...
I was going to say, let's say I didn't fall that far.
Yeah.
And I can't work, but I'm not dead.
You're not dead, but you've bust up your leg and you can't move for a period of time. And I know it's something that you've kind of experienced personally. So there's insurance to help cover your income for a period of time that you're off work because of illness or accident. That tends to be a bit more expensive, but actually the risk of that happening to you is probably higher than you dying in the period of time that you're working. So it's something to consider, and various providers offer those types of insurances.
The challenge you've got as well, Neil, is whilst you want to provide for your lifetime, or your lifestyle, there's arguably a contrary problem. If you've got too much, it just causes issues in other ways, doesn't it?
Yeah.
Because if you die with too much stuff, you're the next generation, your descendants, are just going to lose a lot of money in inheritance tax, for instance.
Yeah.
So you say, well, I want 30 grand a year forever. Yeah. Right, okay, well, why are you sitting on 20 million pound then?
Yeah.
So you must have interesting conversations where people are saying, well, I'm worried about retirement, who don't need to worry, and they've actually got different worries. Mm-hmm. And then you need to start helping them move assets away from their estates, don't you?
Yeah, I mean, it actually is quite a common issue that we have with a lot of our clients. They've maybe worked with us for a while. They're quite secure in the money that they've got, and they know that they'll probably have enough, and we can demonstrate that by modelling various assumptions about interest rates and inflation and investment returns and longevity and all that stuff. And then actually comes down to, well, what is that money to do? Again, it's the same question. What's the money for? And for many, they want to give money away to their kids, usually when they're fitting well, to see them enjoy it, be it getting on the housing ladder or helping with school fees or whatever it might be. We can help them demonstrate the impact of them giving that money on their own situation. Will it affect them, or actually can
they afford to give that money away?
Yeah, absolutely. And their motivation might be to save tax. Inheritance tax is a relatively small tax in terms of the revenue that the government gets from
it's a big
that
percentage
tax.
Of someone's estate if it affects them, but it doesn't affect as many people as...
That's right. I mean, it's relatively modest overall in the grand scheme of things, but still people are motivated to, a lot of the comments are, I've paid tax all my life, I don't see why I should pay it when I die as well.
Yeah.
And
you only die if you die with it though, don't you? That's the thing.
And
yeah.
you don't most people don't want to be the richest person in the graveyard. So, and again, sorry, a bit of a cliche, but a habit or a saying that I often use is better to give with a warm hand than a cold hand.
And a cold hand, yeah.
So we can help devise some strategies to help their family at the same time reduce their inheritance tax liability.
Do you find so one of the things you mentioned to me often is people say, well, my business is the pension. Let's just say business is the pension, Neil, or why would I don't need you, do I?
It's again comes back to the question of risk and diversification. Yeah. You might have the most successful business that's been running for years and years and years, and you may be very comfortable with it. And if that's you and that's how you feel, fair play, on you go. But if you're Kodak, on the other hand, a bad debt or not adapting to a change in the marketplace of the product or service that you sell, tax goes up, and or unexpected costs come along that
technology,
all of that
wipes out your industry altogether.
Absolutely, things change. So why rely on just one thing when you could spread that risk very easily by perhaps invest in some surplus profits in a pension and an investment, wherever it might be, in property, it could be anything, just to spread that risk so you're not overly reliant on one source of income or wealth in the future. Yeah,
okay. What I haven't primed you for this, so time where I put you on the spot a little bit. Okay. Give us your 3 basic tips where to start then. And I'll offer you a first one because you've already kind of said it then. Yeah. Get your budget, sort out what you spend, what your basics, your essentials, your luxuries. Yeah. We'll start there. What else should people do then? If people are sitting thinking, well, this is all great, I'm not there yet, but I want to be. Where do they get started?
It is very basic. So, as you said, work out what comes in, what goes out, what extra you've got. Try and work out how comfortable you are with that number and how much of that number you are then prepared to use for your future objectives. After that, as we've already said, it's probably a case of maybe building up a small savings reserve, considering reducing some debt, getting the insurance sorted out so you're comfortable if the worst happens, you're protected.
So that's your plan B.
Once you've ticked all those sort of basic boxes, then it's a case of, well, I've got this extra, I can invest. And then it's a case of working out what the time scale for that investment might be. So if you're sitting as a 30-year-old now and you're thinking, well, I've got the house, family's now set up, we've got all these other boxes ticked, I'm looking to the long term, it might be pension's the most appropriate thing. I can add that surplus to my pension, or it might be, if you've got a shorter time frame, that something like an ISA might be more appropriate because it's a shorter term type of investment that you can access more easily. Basically devote as much as you can of the amount that you're comfortable with to that type of saving or that type of investment.
I like what you said before. You said something like cash is just deferred spending. Is it?
Yeah.
Is that what you said?
Yeah. So what, I guess philosophical, why do you save? Well, most people save because they want to spend something in the future.
Yeah. It's a rainy day account.
Absolutely. It is a bit old fashioned in these days. There's various psychological research on instant gratification and wanting things now and all that, and people are sometimes reluctant to put something away for the future that they can't benefit from immediately. So it's maybe a touch old-fashioned, but ultimately it works.
I'm a fan in delayed gratification kind of model of if you want to achieve something great in your job, your career, work hard at it and it'll come. Don't expect it at the end of your first week.
It's like anything, whether it's, losing weight, whether it's getting healthier, whether it's saving, it takes time and it's the accumulation of good days. So if you can, or good months or good years, if you take small steps but do them frequently enough, then you should be able to get to where you want to be.
And do you think a lot of people set out, Neil, and think, I can save a little bit, and then look in like a year's time and go, what was the point in that? I'll just buy a car, or I don't know. Is it like, do people just give up, or do people never start in the first place? What derails people?
I guess it could be a number of things. We're fortunate that the typical clients we deal with, we don't see that type of thing happening. So, but it could be could be anything. You might not be getting satisfactory returns. You might be paying too much for something, and the fees are eroding the real value. So that's something that we would certainly look at. It might be just feels like too far away, too big a goal to achieve, and the £10 a month doesn't seem to be doing it. But
it's not going to get them the 30 grand a year pension, is it? So they give up.
Yeah, but then there's this thing, it's often quoted, the eighth wonder of the world, this magic compounding interest, and that's getting a return on the returns you've achieved, and that just snowballs over time. And the longer you can leave that, the bigger the effect that has over time.
Okay, and just finally then, because obviously we're in an interesting time now. We've got Russia, Ukraine going on. We've got inflation at something like 40, 50, 60-year record levels in the US. After they've spent all this money on things. World events can sometimes undo any good planning, can't they? If you look on a short term. What advice would you give to people who are like panicking right now, going, well, hold on, the market's erratic? I know you can't give specific advice, but would you just say, ride it out? You're in here for a 30-year game. What happens this year doesn't matter.
Again, you go back to the individual circumstances. But for the majority of people, and we've had this experience as a business through the credit crisis in 2007, 8, 9, that kind of time. Obviously, COVID's been a recent thing that that's had an effect on stock markets immediately, and we've had clients reacting or wanting to react to these things. 9 times out of 10, the right answer is do nothing, and it seems kind of counterintuitive. It seems, it might be frustrating for some people to feel like they've got to take some action to improve their situation, but it very much is the case that whether it's Ukraine, Russia, inflation, whatever it is, the crisis du jour, it always happens. It's not different from what's gone on before.
Same day, different shit.
Yeah, absolutely. History suggests that if you don't react to stock market falls, which I guess is what we're really talking about mainly, you will tend to be in a better position having not done anything in a year's time than you would have been. Because I think
there's evidence that a lot of people they feel the pain and then they quit at the point where they really that's the point where you were just about to bounce. And there's like a lot of people get out at the bottom of a market.
Yeah, it's
because they've missed the drop. It's very hard to spot a drop coming.
Absolutely.
And think, well, I've lost 20% in the last month. I'm getting out.
Yeah.
And then of course it's the bold investors who think now's the time to get in, and they reap that reward, don't they?
Yeah, I mean we're not actually advocates of market timing, because again research suggests that nobody, whether you're you or I, average blokes, or whether you're highly paid fund managers sitting in London or New York or whoever you are, Warren Buffett or whoever, it's impossible to get investment timing right consistently. You might predict something's going to happen. You might predict a crash and get out just before it happens, or you might think, right, we're at the very bottom of the market and get the timing right. But to do that week on week, month on month, year on year is impossible. So we think don't even try that, but trust the market to produce good long-term returns. It might be volatile. It might be, if you look at a graph of a stock market index, it might be very spiky. That's volatility. That's a type of risk. We tend to encourage clients to ignore that. Again, we'll re-emphasize things like you've got enough income to meet your lifestyle expenditure. You've set aside a bit of money for emergencies.
Because this money's the deferred spend anyway,
isn't it? This is the
it?
Extra stuff.
It might have dropped a bit. You've got time for it to come back.
Absolutely.
Yeah.
I mean, we would adjust your plan if you need your money next week or next month or next year. But if you're looking at, again, going back to the young person just starting work, just joining the company pension scheme, paying £100 a month in some ways a market fall is great for you, because you're buying more next month than you did this month with the same £100.
You get more for that £100 next month.
Absolutely. Yeah. So generally the advice is don't panic, don't do anything, don't overreact, stick with the plan, you'll be fine.
Something else that I learned from you many years ago now as well is that you can look at the top 50 performing funds over the last 5 years.
Yeah.
Most of them won't be the top 50 performing funds in the next 5 years. Is that still the case?
Yeah, again, lots of research on that.
I'll just do it myself. I've been on, I've had a look. They've done great.
Sure.
The chances of them doing great again up.
Yeah, I mean, I think the stats say, and we kind of buy into this type of research and this philosophy, I guess, is that you're right. If you look at the top, we call quartiles, the top 25% of funds measured over, say, the last 5 years, of those that are in the top 25% over the last 5 years, less than 25% of those will be in the top 25% in the next 5 years. And it's actually impossible for me as an advisor or you as an investor to pick which of those 25% will be in that top 25%.
Which ones are going to repeat it? Who knows?
So we as a firm don't tend to use that type of investing. It's called active fund management. We tend to prefer index funds, which is where you're buying the market as a whole rather than taking bets on which funds will outperform in the future. We don't think you can do that with any certainty. We tend to reduce your costs, buy the market, and trust the market to do its job.
Good. Okay then. And how do people get in touch with you, Neil, if they want to?
Just the usual contacts for Robson Laidler, so our office number, our website, or our email. I think all those details are on the website. So
we'll put everything in the link on the comments below. So thanks very much, Neil. That's been great.
Thank you, Mark.
I hope people have got some value from that on how to maximise most of their resources, making the most of their resources. Always a pleasure, Neil. Thank you very much.
Thanks, Mark.